Over the past year, PayPal, ticker PYPL, is up by almost 50%. Now, I started adding this company to my portfolio more than a year ago, and since then I saw a great return. So today I want to figure out whether at its current trading price the company is still undervalued, and if buying it now will still yield good return. And to do this, we will use our stock valuation spreadsheets, where as always we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of PayPal using our 4 valuation models. Now first of all, we have to plug in PayPal's ticker PYPL, and we can see that all the metrics show up automatically. Now one thing I love about PayPal is if we have a look down here, we can see that their market cap is sitting at 87 billion and their enterprise value is sitting at 88 billion. Which means that they only have about $1 billion in debt, which is almost nothing compared to their enterprise value. Now jumping to the 9-pillar analysis, we can see that the company gets a rating of 7 out of 9, which is a very decent rating, with 2 of the pillars sitting in the red, the 5-year PE ratio and the price to free cash flow. Now if we have a closer look at these 2 pillars, we can see that the PE ratio has actually been decreasing at a rate of 15.25% over the past 5 years and currently is sitting at only 20.71. Now what the decreasing PE ratio means is that investors pay less money for every dollar of the company's earnings. So in 2019, an investor would pay $65.30 for every dollar of the company's earnings, and currently they only pay $20.71 for every dollar of the company's earnings, which is a huge difference. And the lower the PE ratio, the better. And this is the same case with the price to free cash flow. On average, it has been sitting at 29.70, but currently it's sitting at 22.77. So in reality, the 2 pillars highlighted in red aren't actually all that bad. Now something I think is worth mentioning is that if we jump to Seeking Alpha, we can compare the PE ratio of the company to the price of the company over the past 5 years. And we can see that the high PE ratio actually pushed the stock price of PayPal down. And sometime after the PE ratio dropped below 22.5, investors realized that the company is trading undervalued compared to their earnings, and the price of the company started rising and is currently still rising as the PE ratio is still at a very decent value. Now we can also have a look at PayPal's growth. We can see that their revenue has been growing at 12.26% yearly over the past 5 years on average. Their free cash flow has been growing at 9.35% yearly, and their net income has been growing at 21.59% yearly. And whenever I see a company growing their revenue, free cash flow and net income, it makes me happy, as the one main thing a company needs to increase in price is growth in these 3 areas. Now before we continue, I just want to say these spreadsheets are very useful to both beginner and advanced investors. Whenever you see a company on the internet that interests you, you can simply jump to these spreadsheets, plug in the company's ticker, figure out its intrinsic value and go through the 9-pillar analysis and understand whether it is worth researching this company further to possibly add it to your portfolio, or whether the company is simply not worth your time. And currently we are running a Christmas discount. You can find the discount code in the description. It's a discount for 20%, and if these valuation spreadsheets interest you, you can pick them up right now. Now getting straight back to the valuation, we still have 3 more pillars to go through, and we can see that the 5-year profit margin of PayPal is currently sitting at 44.10%, which is well in the range we like to see. But if we have a look at the 6th pillar, we can see that it has been decreasing slightly over the past 5 years at a rate of 2.11%. Now this doesn't bother me that much as the rate of decrease is very low and the profit margin is still very high, but it is something I will keep my eye on. Another thing I like about PayPal is their decreasing shares outstanding at a rate of 2.29% yearly, and their very low long-term liabilities over the 5-year free cash flow negative dividends to be below 5 ratio, sitting at 0.57. Now what this ratio means is that PayPal generates enough free cash flow to cover all their long-term liabilities while paying out their current dividend to not get into trouble with debt. Though again, PayPal has been increasing their long-term liabilities at a rate of 14.11% yearly over the past 5 years, so again that is something I will keep my eye out for. Now we can finally move to calculating PayPal's intrinsic value, first using the Graham's formula revised. And here we take the 5-year earnings per share, the base PE sitting at 7, the growth rate multiplier sitting at 1.5, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value. But first we have to predict the 5-year earnings growth estimate. And to do this, we can have a look back at pillar number 4, where we can have a look at the net income, which has been growing on average by 21.5% yearly. So if we jump back, we can predict a high earnings per share growth of 18%, a medium earnings per share growth of 12%, and a low earnings per share growth of 9%. And combining that with the earnings per share growth the analysts project, we get an average 5-year earnings per share growth estimate of 10.82% yearly. And with that, we get an intrinsic value of $77.11, which is actually currently 13% lower than the current trading price. But we still have 3 more valuations to go through, so let's jump to the discounted cash flow model, where we plug in the free cash flow of the company and calculate an average growth rate of 9.35%. Now, to predict the future growth rate, we again use the same method. So based on our 9-pillar analysis and based on the research I did in the backend, I predict a high growth of 16%, a medium growth of 13%, and a low growth of 9%. And using that, averaging all these out, we can then calculate the growth rate into the future of 12.7%. We then calculate the future free cash flow. Now, to calculate the present value of that future free cash flow, we have to plug in a discount rate, which is essentially the minimum rate of return you want from your company yearly. So again, we use the same method. We take the high year-over-year return, the medium year-over-year return, and the low year-over-year return, and average it out with the WACC of the company to get a discount rate of 9%. And now we take the present value of that future free cash flow over the next 10 years, including the terminal value. We add cash and cash equivalents, subtract total debt, and get an equity value, which we divide by the shares outstanding and get an intrinsic value of $109.98, which shows us that PayPal is undervalued compared to their free cash flow and their free cash flow growth. Now let's jump to our third valuation model, the multiples valuation, where we compare PayPal to its competitors. So FIS and GPN. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which we average out and multiply by the earnings per share of PayPal to get an intrinsic value of $117.38. Now essentially this is going back to the PE ratio. When the PE ratio of the competitors on average is higher than the PE ratio of PayPal, it means that PayPal is undervalued compared to its peers. Now normally we would go through the dividend discount model, but as PayPal doesn't pay out any dividends, we will skip this and arrive straight to the ultimate intrinsic value, where we average out the 3 valuation models and get an intrinsic value of $101.49, which is currently still about 17% higher than the current trading price of the company. And if we plug in a margin of safety of 10%, we get an acceptable buy price at $91.34. Now, if I try to plug in a margin of safety of 15%, we would probably still be able to buy the company at its current trading price. Now, personally, I'm a big investor into PayPal, and I believe that it will grow even more into the future. We saw that its 9-pillar analysis is looking very nice, and their intrinsic value is sitting higher than its current trading price. I also believe that with the current digitalization, PayPal will be used even more than it currently is being used, and they also own Venmo, which is another positive. And with that, I hope that you enjoyed the valuation. Let me know down in the comments which company you'd like me to evaluate next, and leave a like and subscribe as it really helps me out.